Paul, one of our banger videos that we've done, surprisingly, was our AT&T video we did.
That's the one that took us to 1,000 subscribers.
And we were hesitant on that, guy, because it's kind of a boring, it was boring. My mom worked there for 50 years, and I was like, you know what? We should talk about this. I know you dividend investors love this puppy. And I always have asked you questions, Paul, like, why do we love a stock that literally hasn't moved in 30 years? But people love getting that dividend check. They love that extra cheddar that they're getting. So there's recent news about a merger. They're increasing their dividend. They're decreasing their dividend. It's all over the place.
Look at this chart of AT&T over the last 10 years. It's literally in the exact same spot.
Nothing's happened.
Nothing's changed.
I'm certain their revenue has gone crazy. So
I don't know about gone crazy, but it's probably up.
So what is it about a company like this that people are so drawn to, Paul? Is it just look at that dividend? So is it just the amazing dividend? I mean, what is it about AT&T?
So first off, guys, follow us on Instagram. It helps us out a lot. So one of the fundamental things I want to talk about here is a boring, stagnant company is still worth something. If we had two companies, one makes $1 a year for the rest of the time, and one just increases by $1 a year for the rest of the time. Okay? Which one would the average person say, I want to buy?
Two.
Probably number two, right? People would say, I don't want this. Now I sit there and say, this one can be bought for $1, this can be bought for $10 million. Which one do you want now?
One.
Correct. That's the thing in investing, guys. The thing I want you to understand in investing is it's possible to overpay for a better situation. Just because we think it's better, let's bid it up. When things are boring, those are the situations I want to find, because if it's boring to the average person, they don't want to own the stock price stays down. Are there still ways for the stock price to go up? Absolutely. For a company, we talk about shares outstanding all the time, right, Seth?
Mm-hmm.
Let's say a company will make $10 a share the rest of their lives, $10 in profit overall for the rest of their lives, and they have 10 shares. That's $1 per share. But every year for the next 5 years, they decrease their shares. They end up getting down to 5. Now, and they still make $10. Now they make $2 a share. If you own one share of the company, you're now getting $2 of that profit versus 1. So now your stock is essentially worth double. Because if you're willing to pay 15 times earnings here, it's a $15 stock. 15 times here, though, it's a $30 stock. That's how you get share growth in a stagnant company. And companies know this. I'm looking at AT&T, and they're paying a big dividend. That's very attractive to a lot of people. That's a good thing. I like the fact they're taking their cash, saying, listen, we can't do anything with this cash. We're too big of a company. Let's give it back to the investors. Let's pay them a dividend. It's very tax inefficient. I've said in past videos, I wish AT&T would do more stock buybacks because they're a cheaper company. Let's go look at the numbers right now.
We're going to use our 8 pillars to look at the financials behind AT&T, not just look at a stock price, buy it, and hope it goes up. We want to look at the financials. What has happened in the past? This will help us project the future of AT&T, their earning, and hopefully their stock price. We'll use the stock analyzer tool, as you can get as part of our software at everythingmoney.com, and we will take a look at Mo to see what's going on in the bid and ask nation, people who are trading AT&T. Paul, this dividend's getting cut recently.
Yep.
And so the stock price has not been doing well of late.
Well, I mean, I think it's still, what's the dividend being cut to, by the way?
Yeah, the numbers are all over the place.
Is it in half?
They do it, yeah, in half. That's correct.
Yeah, so now it's going to be still a 3.8% dividend yield versus the market of 1.2, 1.3%. But let's go through the analysis. This is a $200 billion company. Mm-hmm. Their 5-year PE is 13.6. Okay, we want it to be less than 22.5.
Damn, that's
so this is a massive check mark. Okay. Return on invested capital, very low, 5.2%. That's an X. We want it over 9%. With a company like AT&T, they're not doing a great job of investing their capital back into the business. I don't know why, but this is something you want to pay. You want to have a discount when their return on invested capital is low. Because it's basically saying, hey, all the equity we get, all the debt we get, we don't do a good job of really investing it in other opportunities. Okay. Now, look at this free cash flow, Seth. Look at their 5-year average free cash flow.
$23 billion.
$23.5 billion. Last year's free cash flow, 29. Even on last year's dividends of $15 billion, they had plenty left over. Now they're cutting it in half. They're easily going to be able to pay that dividend.
I see.
Pardon me. So far, we have one check and one X.
Pillar number 3 is revenue growth over the past 5 years.
Now, you said something like the revenue growth is huge. I was like, there's no way it's huge. And look at it.
Of course.
162 to 176. But in the last 10 years, now granted, I will say this, guys, I guarantee a lot of this is driven by acquisitions. And you can get that number in the cash flow statement. So you can sit there. We want to see revenue growth being intrinsically growing, naturally growing, not just from acquisitions. If I own a company that does $1 million a year in revenue, and I buy another company that does $1 million a year in revenue, I could brag, look, I doubled my revenue. No, you bought another company, right? Would you rather have a company that takes $1 million and makes it into two on its own, or makes an acquisition to get there?
Ah, I see, of course.
Right? Now, granted, I'm not saying acquisitions are bad. We'll get that topic altogether, but we want to see companies that naturally grow revenue. So that's one of the things that this does not show you off the bat.
Yeah, so Paul, if folks want to get this software and in the 10K, so you can look deeper into this. This is right in our software. You can click 2 buttons to get right to the quarterly 10K to analyze even deeper down on AT&T. It's all available on the Everything Money software. Paul, keep going with profit growth over the past 4 years.
Look at this, 13 billion to negative 2 billion.
Uh-oh.
So you're sitting there going, wait a second, how did they lose so much money? Seth, this is why we love our software.
Go on.
This is why we love what we teach. One-time special income and charges, $21 billion. Guys, they did a $21 billion write-off in the last 12 months. So one of your goals, one of your jobs is to sit there and figure out what was that write-off. Last year, they did a $4 billion write-off. And you see it in the fact that it's a write-off because their cash flow did not get affected. You will see their cash flow later on in this video that the cash flow is still a positive $20-some billion.
Yeah, Paul. So AT&T announces a $43 billion deal to merge with Warner Media and to merge Warner Media with Discovery. Discovery shareholders will own 29% of the new company.
Yeah, but what was the write-off? That's not part of the write-off.
Oh, sorry.
No. So a lot of people do this. Buying a company doesn't hit the expense column, doesn't hit the income and expenses. A write-off is when they later on go, oh, whoops, we screwed up. We got to write some asset down.
It was probably DirecTV.
Yeah, you're right.
DirecTV?
Mo's right. They did a major write-down for declining premium video business. The telecom took a $50.5 billion write-down on its DirecTV satellite business. Yeah. Wow.
So there was another write-down on top of that, too, for another 5 or 6.
So what's a write-down again?
So let's say you have let's say you bought a building for $1 million.
Go on.
The way accounting works is that is not an expense because you bought a fixed asset.
Asset, yeah, that's right.
That goes to your balance sheet. Now let's say 2 years from now you're like, whoops, we overpaid. That building was really worth $500,000. So it's on your balance sheet for $1 million. I will just actually write this out. It's on your balance sheet for $1 million. And you sit there and say, oops, it's worth $500,000. You get to write off $500,000. That will then hit your income statement and other incomes and expenses.
Oh, okay. So
you get to write that value off because you have to take the value off the books from $1 million to $500,000. So what AT&T did there was they had a DirecTV investment. But they said, oh, look, we had Motorola. By the way, Microsoft did this with Motorola years ago. They bought Motorola, realized 3 or 4 years later it was a terrible deal, wrote off $7 billion, something like that. This happens very regularly. It is something you need to look at. Now, I will say this about AT&T that I like a lot, Seth.
Go on.
Look at the last 10 years. These are the only years of one-time write-offs.
Ah, okay.
By the way, the same thing to look at, guys, if they sell a division and make a lot of money off of it, they're going to have a special income that's high. So you always want to look at that and make sure it's not skewing to the high or low. And if you see consistent write-offs over the years, they're just bad at investing and you need to factor that into your investing. If every single year they wrote off $2 billion from some poor purchase, I would sit there and say, listen, you just got to write off $2 billion a year. Then you don't add it back in there.
And with the number of acquisitions that AT&T does historically, that's pretty damn good to not see a lot of write-downs.
Yeah,
I mean, they're an acquisition business. They acquire a lot of businesses.
So
pillar number 5 is shares outstanding. Paul, we want this number going down.
It is not. 6.17 to 7.17. I'm sure this is an acquisition idea. A lot of times companies will issue shares. A lot of times companies will issue shares in order to make an acquisition instead of using cash. Now, you can make the argument there that if the acquisition is good, you're okay because let's say, for example, I had 10 shares in my business and my business is worth $100. That's $10 a share. If I bought another business for $50, I issued 5 more shares, nothing's changed. Because I've added $50 in value to my $100, it's still worth $10 a share. So it can still be good to make acquisitions using shares. So I wouldn't exactly hold AT&T responsible for this and hate them for it, but it's just something to keep in mind in the back of your head as you do it.
If you're drawn to the financials of this company or any company in your investment portfolio, you can have this software and finally get a grasp on what these companies are doing behind the scenes. The Everything Money software at everythingmoney.com gives you access to the stock analyzer tool. You'll join our Discord community where you can talk to Mo about trading on a daily basis. The best software out there. Paul, show us why.
It's phenomenal. Guys, Seth already went through the major aspects. It's a mobile app, 8 pillars, 30 years of financial data. The Discord community, I think I might be wrong. I think it's 6,000 plus people that are buyers of the software right now. All guys for 87 cents a day. You get exclusive content for us. That alone is worth 87 cents a day. You get all of this. Our competitors are $200 a month, $200 a month, and $35, but you get all of ours. It's a no-brainer. This will literally, if you follow our steps, will make you hundreds of thousands, if not millions extra in retirement. It's a no-brainer for less than a cup of coffee.
You got to follow those steps, though, Paul. You got to be disciplined. You got to follow it. Pillar number 6 is total long-term liabilities divided by 5-year free cash flow. We want this number under 5, Paul.
Now, Seth, I used to quiz you in the past when we'd have these pillars, right?
Go on.
I haven't quizzed you on this one. Can you explain this to us?
So their total long-term liabilities is basically their debts or the things that they owe, right?
The long-term ones,
Long-term ones. And then their 5-year, their free cash flow is, I still to this day get confused a little bit about the hand-in-hand of like income versus free cash.
Income is a part of the calculation of free cash, but you're basically taking your free cash flow the last 5 years, which we have on this main page right here of $23.5 billion, multiply it by 5. That is $117 billion, $117.5 billion. We want their total long-term liabilities to be less than that. Why? This is a starting point for a number, right? There are some companies like retail companies that capitalize their leases that have huge debt levels. But at the end of the day, if you have less debt, you're less likely to go bankrupt.
Yeah.
It's a very simple fact. If 2 households have the exact same income, but one has 10 times more debt than the other one, who's more likely to go bankrupt?
Especially during a market correction.
Or anything, just losing your job for whatever reason.
Yeah.
That's the point here. So what we do is we go to the balance sheet and we go to our long-term liabilities at the very bottom. Oh my Lord.
Uh-oh.
$282 billion versus $117.5 billion that we wanted. That's an X. You got a lot of debt. Is it good or bad? I don't know. But the point is that these 8 pillars are a starting point for more research if you decide to go look forward into the company.
Pillar number 7 is free cash flow growth.
Boy, I love this one. So free cash flow. Cash from operations less your capital expenditures. 15.3 to 28.8. Check mark. Look at this growth, Seth.
How about love?
It's been growing. Now, the average of the last 5 years is 20. Now remember, guys, the company had $2 billion loss last year, and they still showed $28.8 billion in free cash flow. That's that big write-off. So 23.5 times 5 times 20, is what? $470 billion?
Really? The market cap's 197.
Yeah. So, guys, this is very, very interesting play on AT&T.
Interessante.
Now, I will say, and by the way, remember the acquisitions? Look at this. $20 billion acquisition, $1 billion, 3.5, oh, they sold off stuff. $42 billion acquisition. That's what drove their revenue jumps right here. So keep that in mind when you're looking at the company. I wish AT&T would buy back shares. That's what I wish they would do. I don't own any AT&T right now. I want to see a real buyback program that's really interested in, and also I want to see less expensive acquisitions. Acquisitions make people happy because it makes them look like they're trying really hard, but acquisitions tend to be, I watched the first episode of Succession the other day, right? And in it was so funny. They just kept bidding up the price of these companies. Why? They need to make a splash. And as much as that's fiction, it's also reality. CEOs feel like if they're sitting on their hands and not making acquisitions, people are going to say you're not doing anything to drive shareholder value. So these are the things to consider. I like AT&T just from this cash flow metric. I mean, it's selling for like 6 or 7 times free cash flow. That's nothing. That's nothing. But I want to see at least a stabilization of issuing shares, even as for acquisitions. Use the cash to make acquisitions.
If you want to make acquisitions of AT&T in a faster pace, you can join Mo in the Bid and Ask. Mo, are people trading AT&T with those?
Golfing candlestick.
This is a hard stock to trade just because it is a dinosaur. It doesn't move much. But let's look back. I mean, just pre-COVID, that was your high. This is your low. So this is absolutely a 50% roll stock. And what that is, for those of you that don't know, it's just negative pressure pushing down on the stock of all resistance. So these people that lost money in here, they just want to get half their money back. They do, and the stock falls back down again, up again, down, up again, down. So the good thing is, let's zoom in a little bit and just look at this recent gap. Maybe we could take advantage of this. I say 90% of the time gaps fill, and here's your gap that happened about in May. So this is a dog stock for sure. It's just sitting on the bottom, coasting on the side, really not doing anything as the stock price keeps declining. But eventually, I think this thing will get some positive sentiment because of that high dividend. Even with it being cut in half, it's still higher than the market average. Institutions and big financial advisors, they're going to flock to this stock. When that happens, you'll be able to make a trade on this thing and hopefully fill that gap. But for the time being, I would avoid.
Really?
Yeah.
There's not much volatility in this stock
That's
either,
the thing.
right?
I mean,
you want a little volatility when you trade.
Yeah, you can't day trade it. I mean, even from this perspective, we've gone from, 20 in the past, since June, it's gone from about $29.40 to $27.50. So that's a very long time to not make a lot of money, even on a short.
Even on a short position, exactly. You're not making anything.
So it's one of those where it's probably better to not be in this one.
All right, Paul, let's go over to the stock analyzer tool. The final piece of the puzzle is to see what should we be paying for this. If we want to do some more due diligence, look, read that 10K, listen to the conference calls. We can do all that, but what should we be paying for, Paul? Go ahead.
So guys, this is a tough company, and the big reason is their profit margin and their free cash flow margin are very different numbers. Look at 10 years, 8% versus 12.5%. You want free cash flow and earnings to be pretty similar. I like it more when the free cash flow is higher than earnings, though, because it's easier to manipulate earnings. I get concerned when earnings are higher than free cash flow. So here, guys, we're putting up a snapshot of all the metrics, I hit the analyze button. This is all over the board, Seth. Look at this. Like the multiple, if you base it fully on free cash flow, it's a buy all day right now. Mm-hmm. If you base it purely on free cash flow, you base it on earnings, you got to wait till the mid-20s. So I do think right now, based on my assumptions, it's probably a reasonable purchase right now. I think you're going to do okay. Mm-hmm. You're probably going to make 10 to 12% if all my assumptions come true. The question becomes, do you believe that? It's not a sexy stock. I get scared when people are trying to make acquisitions. So be more conservative in this company because I don't want them to piss away their mony on other things. But boy, that cash flow is awesome.
The move that they made, writing down DirecTV, and then realizing that they have issues and spinning off with that was like, okay, maybe management's stepping it up a little bit here, and it's a step in the right direction. There's a long way to go before we find out if this is for real, but it's a step in the right direction. That's
our take on AT&T. Get the software below. Click the link below to get Everything Money software. Join our community. You can talk with us about these very trades. And join Mo in the morning, 9 a.m. Eastern, to talk about news and analysis. And our live streams are Tuesday at 2 p.m. Eastern. We go live for the whole world. That's our take. Yeah, final thumbs up. And we're giving away a Tesla. So get in our community because one of our community members is getting a Tesla by Thanksgiving. That's our show. Thanks for watching. Love you.